Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, in this episode, I want to get into the implications of what the administration, so President Trump and the administration has called Liberation Day. So the idea of imposing really quite significant and sort of broad tariffs and what is now a real protectionist shift in international relations and trade policy. So we want to kind of get into things that led up to that. We want to unpack it a little bit and then talk, of course, about economic market and investment implications. But let's take a step back and first look at sort of what's been going on. I would say, generally speaking, there's been a lot of nervousness around the uncertainty of trade policy. And part of that was sort of driven by what felt like an on-again, off-again type of approach. Announce a tariff, hold back, maybe provide some relief, then say they're going to implement it. And that sort of uncertainty we've talked a little bit about, that sort of back and forth. And so that honestly, there was some optimism just around the idea of clarity, the idea that we were going to have this day where the administration would lay out its policy. And candidly, there was talk even of basically market relief, or almost like the potential for a relief rally if everything kind of made sense and didn't seem too extreme or whatever. And of course, that didn't happen. We had a really negative day in the market the day after the announcement, and then while it's morning pre-market, the Friday of this week, right now futures are pointed down again. We'll see how that unfolds through the day. But point being, the market's really been shaken a little bit by this, and so of course it warrants a lot of attention and focus. So let's get into it a little bit in terms of essentially, let's first look at what in the world the administration's up to. So basically, I think what's in focus in some simple terms is this idea that so much in terms of goods production has gone offshore, and that we are essentially operating at a trade deficit, meaning that our imports are greater than our exports. It's to the tune in 2024 of over $900 billion. And that's in focus, right? And I think the theory sort of says, and at least it's the administration's position, that if we eliminate all the friction, tariffs and other conduct, basically, that the trade balance should be about zero. And so, at some level, what this is about, of course, is trying to bring manufacturing and other things back to the U.S., kind of strengthen our position as a provider of goods, and we're already in a pretty strong spot as it relates to services, and so this whole idea was to try to impose some tariffs to ultimately get there, and we'll get into some of those details. But there was a lot of confusion about when the administration talked about reciprocal tariffs, really what they were talking about. And I think that the concept goes that the administration believes there are unfair practices going on. So you can think, of course, of tariffs, but then, so if somebody's charging more tariffs than we do, that's quote unquote not fair. But there are other charges like a value-added tax, or maybe other practices like subsidies or currency manipulation, make their currency cheaper, and other non-tariff barriers. And so rather than try to make sense of all that individually, bottom up, the administration said, well, hey, let's look at the trade deficit sort of country by country and figure out what the tariff needs to be to bring the trade balance to zero. And so, for example, with the China situation, the implied tariff is 67%. That would bring us to a trade balance of zero. Now, the administration in practice basically cut that in about half. So they kind of took a big step towards it, but not to it. And, it's an interesting approach, is to say, we're not going to try to unpack why this imbalance exists. We're simply going to calculate and implement tariffs to try to offset them a bit. Now, and that's led to some pretty big numbers for certain countries. And anyway, when we get to sort of the motivation, so I mentioned the idea of onshoring things, so reshoring manufacturing, creating U.S. jobs. That I would say falls under the economic growth and job creation category. There's a sense of leveling the playing field, so fair trade, and therefore support of domestic industries. And I would say, once again, even though there's a lot of press about, this is locked and it's not going to change, officials have been talking about, basically a willingness to go to the table and negotiate and de-escalate in a way the whole situation. And then there is this other layer, just to be clear, about sort of national security and economic sovereignty. And that takes a few different dimensions. One is, being self-reliant when it comes to producing arms and things like that. So having more production here in the U.S., but then also things like combating drug trafficking, right? And so things that are goals that we have around our security and sovereignty. And so anyway, when it comes to these tariffs, I mentioned China. When you add what was already in place, the China tariff rate right now is 54%. Other large ones include Vietnam at 46%, Taiwan at 32%, and Japan at 24%, and then the EU at 20%. And, people look at the EU and wonder about that. But one thing that's kind of simple is the value-added tax. They have a big value-added tax that they impose. And so, there's definitely, with 20%, we're probably in the neighborhood of some parity there. In any event, interestingly, the goods meeting what are called the USMCA rules of origin won't have tariffs. So there were some tariffs imposed on Mexico and Canada, but to some degree, there's honoring of that original USMCA trade agreement. And then, interestingly, across many smaller trading partners, basically a 10% tariff. So an aggressive move for sure. And, I think the administration, I even saw an interview where there was a discussion about the idea of this sort of creating a balance. Initially, it's going to create a decent amount of revenue that's helpful to the government. But over time, as the basically trade gets more into balance, the revenue comes down. Maybe they negotiate sort of cleaner arrangements, but it results in the reshoring of business here, and that translates to business tax income and individual jobs, and therefore some additional taxes there. And so there's kind of a view that this is net positive in terms of revenue for the government, which of course in the fiscal trajectory sense, what we've talked about, having deficits that are too high, that's an incremental positive. Now, those are all sort of the explanations as to what's going on and some of the, sort of longer term potentially positive considerations. But of course, what's in keen focus and should be are the economic implications, both in terms of a slowdown in GDP, a potential recession. The probabilities of a recession have certainly gone up. My team and I, we're still not in the camp that it's over 50%, right? So our base case is still for a slower positive growth, but a significant impact on growth, which honestly we've talked about through the balance of the year. And then, of course, if we're imposing bigger tariffs and some of that translates to higher prices, that's going to have a kind of a one-time effect, at least on inflation. So this idea of inflation cooling, that's going to be offset a little bit here in 2025. And, the Fed's all over it. The market is anticipating further Fed cuts. The 10-year Treasury yield has fallen a bit. In the wake of this, it's sort of the classic risk-off kind of trade that's happened. And so that work kind of top down, where is the economy going, where are earnings going, is super important. It certainly influences our analysis and thinking in terms of looking ahead. With that said, the other work, of course, is what I would describe, and we do describe more as bottom up, which is, okay, we own a bunch of stocks in our portfolios and we've got to go through, and we've been, really digging into this, go through and understand the investment implications at the company level, sometimes the country level too, obviously, given that that's where the tariffs are imposed. And, basically try to understand, okay, how have we experienced price action based upon this news, and is some of that still more to come, or is it overdone? And that's the kind of work, of course, that we have to dig into as we manage portfolios for clients. So anyway, so a lot more to talk about. it's certainly we're in an environment where people have been shaken. Markets have gone lower, but we're still in the camp that things will settle down. We're in the camp that, there's in some ways, when it comes to policy, understandable, and some would say good reason for the effort that's going on to try to create more balance in terms of trade. And the sort of most positive scenario from here would be significant negotiation and sort of bilateral sort of country-to-country agreements between the U.S. and each country to work through this and sort of de-escalate both sides, really, in terms of the cost of trade, all with an eye towards bringing more business back on shore, creating jobs in the U.S. And again, I think the overarching thing, which we've been talking about for years, is we've been in this protectionist kind of shift. And that's been true around the world. It's true here now, more so in the U.S., and that's something we're going to have to understand and deal with. So again, of course, on this topic, much more to come. Listen, thanks for listening to this episode, and we'll catch you on the next one.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.